Today we've got Nick Lardy, who's among his many other accomplishments is vice chairman of the National Committee on U.S.-China Relations. So I'll be particularly careful in my introduction. Nick's bio almost doesn't do full justice because he's really he's the economist's economist. That when you really need to know what's going on, you ask Nick. I mean, I get all these interview questions, and when I hear there's an interview coming up, what do? I pick up the phone and I call Nick and I said, would you please explain to me in layman's terms what's going on? And he always does it very willingly as an incredible source of support for the National Committee. When you read this book, you'll notice early on that it has a terrific thank you in it, an acknowledgement to the Track 2 dialogue of the National Committee on U.S.-China Relations as having influenced what is in this book. So it reminds us of, not only we do these public programs, but we do lots of Track 2 dialogues, and in this case it really helped form some of the ideas in what is just a terrific book. And what makes it so terrific? I think for anybody interested in China's economy, it's a must-read. You really just have to read through this. And what makes it, I think, so good is it's truly data-driven. That so many times I sit and listen to people and they say, so-and-so told me this or so-and-so told me that. And I kind of go, but where was the data? And what this book really does is it's got the data, and that's what makes it so terrific. And the analysis along with the data. We didn't know when we planned this date that we would have this report from the World Bank and the Development and Research Center of the State Council coming out early this morning, New York time. But it is out, and I think at the end of his comments, Nick will probably talk a little about the plan that they are talking about versus the plan that you've got in this book for maintaining sustainable development, maintaining the economic development. But it's terrific. Join me in welcoming Nick here. It's great to have you.
Thank you very much, Steve. Just to put my service to the National Committee in context, I want to say that I've been working for the National Committee for 40 years because when I was a graduate student at the University of Michigan in the early 1970s, Alex Eckstein was the president, chairman of the board, or whatever it's, the board level person, and I was supposed to be his research assistant doing things on his research, but in fact he assigned me mostly to do things having to do with the National Committee and advancing their programs. And so I've been involved for quite a few years. This book is, as the title suggests, is trying to explain what China needs to do to sustain the success that it has achieved over the last really almost 3.5 decades now in terms of very, very rapid economic growth and lots of other positive things that I could talk about that I won't because I think most of us know about them. And it is addressing primarily a series of imbalances that have emerged particularly strongly in the economy since roughly the middle of the last decade, maybe 2003, 2004. You can see it on the internal side. The investment share of GDP has gone into the stratosphere. It's averaged almost 45% of GDP since 2004, hit a peak of, we don't have the data for 2011 yet, but hit a peak of almost 49% in 2010. No other economy in the world has ever invested this large a share of what they produce. And obviously, if investment is going up, something has to be going down, and it's consumption. Consumption has declined, again, as you can see, fairly steadily. It was pretty flat back in the 90s, and then it began to decline in the early part of the last decade. So consumption is very small as a share of the economy. Just for reference, consumption accounts for about 70% of GDP in the United States. China's the country for which the consumption share of GDP is the lowest of any economy that we have data for. There have also been imbalances on the production side. The manufacturing share is very large for a country at China's level of economic development. Its service sector is relatively small. I think in the book I call it diminutive. And of course, China has also had very large external imbalances reflected in very large trade and current account surpluses from roughly 2003, 2004 on. So I'm going to go through and try to explain some of these imbalances, how they arose, and I'm going to focus in particular on what I see the linkages between the internal imbalances and the external imbalances. And just to put my cards on the table, I am strongly of the view that one of the drivers of what's been going on in China is financial repression. Now, there are many different ways you can measure financial repression, but certainly one is what's the real return to saving. And before 2004, the average return on a one-year savings deposit, which is just the nominal interest rate minus inflation, was about 3%. And as you can see from the diagram, for the last 8 years, it's on average, it's been negative about a half a percentage point. Now, the background, of course, is that the central bank is in complete charge of interest rates. They can set any nominal interest rate that they want. The banks all pay that rate of interest. So clearly something, so if inflation goes up, they can raise the rate if they choose to keep the real rate in positive territory. They did not do that beginning in 2004, so the average rate has been negative, and as you can see in some periods, in some individual years like 2008, it's really been quite negative, and it got quite negative around the third quarter of last year as well. What has this done? A couple of things. First of all, it has caused households to save more. My theory is that Chinese households basically are self-insuring. They're worried because they don't have adequate medical coverage. If somebody in their family gets sick, if you go to the hospital, unless you have cash in advance, you're not getting in. Economists sometimes use a fancy term for this, precautionary demand for saving. You don't have a good retirement program, so you save. So you have an idea about what kind of liquidity you need. So if the real interest rate goes down, it's going to take you longer to get to have the kind of liquidity you need, so you compensate by actually saving more. And so that meant that household consumption went down. So really there are two reasons household consumption went down after 2003. One is they earned less from their interest. Chinese households have lots of money in Chinese banks, and their interest income from those deposits declined. That reduced their income, that reduced their consumption. And then compounding that effect, that negative effect on consumption, they began to save more. So if you think back to that diagram on the declining share of consumption, particularly after around 2002, 2003, this is one of the main explanations. So financial repression reduced income and caused people to save more. Now, what did households do with this savings, increased level of savings that emerged in the second half of the last decade? Well, we know they have capital controls. If you're very well connected, you can move your money offshore and invest in real estate in Vancouver or wherever. But most Chinese households can't do that. The Chinese stock market has not been a very strong performer in recent years. It's still down 70% from the 2007 peak. And most Chinese households don't regard, and I'll show you some data later, don't regard equities as a viable long-term asset class. So what has happened is that households increasingly have gone into property, into residential property. And property, as a result of this, has become the main driver of China's economic growth over the last 6 or 7 years. As you can see, it roughly doubled. Now, there are a lot of potential explanations for this. Some people say it's urbanization, but when you look at the numbers, you find out that the urban population was growing by 25 million a year up to about 2003, and 2004 and afterwards, it's only been growing about 19 million a year. So urbanization doesn't look like a natural explanation. I think it's the low rate of return on financial assets. In the first period, you were better off having your money in the bank and earning a positive rate of interest, and house price appreciation was modest. In the second period, you put your money in the bank and watch it evaporate, or you go into property. And much of the property investment in recent years has been people that are buying for investment. There's a very good survey by one of the real estate companies, an independent real estate company, for example, that calculates what percentage of people that are buying flats are doing so because it's going to be their primary residence versus people that are buying them because they think they're going to be able to earn a high return by selling them later. And in the first quarter of 2009, about 40% of all flats being purchased across 30 cities in China were being purchased by people who were buying them for investment purposes. They were not going to be their primary residence. So that's what's driven this into very high levels, over 9% of GDP last year. I don't think this is sustainable, and I'm going to run through quickly a number of reasons. First of all, if you look at China in comparative terms, it's a pretty big outlier. In the U.S., at the peak, we were investing 6% of GDP in residential property in 2005, just before things went bad. India is currently at the level about a little over 5%. I went back and looked at the data for Taiwan. In the 70s and the 80s, when they were growing rapidly, they were urbanizing, roughly at China's level of economic development today. It averaged in that two-decade period about 3%, and the all-time high year was 1980, when they invested a little over 4% of GDP. So China's a big outlier in terms of the share of investment going to property. The second reason I worry about the sustainability of the current pattern is the distribution or the composition of household wealth. You can see in this diagram, basically green is property, and that share has doubled over a little more than a decade. Red is the bank deposits, and that has gone down. It's hard to imagine that the share of urban wealth held in the form of real estate is going to double again in the next 10 years. That would put it up to 80%. China's already an outlier. In the U.S., at the peak in 2005, before the price correction started, American households on average had about 32% of their wealth in residential property. So China's at 40%. How much higher can it go? This diagram also points out that China's financial sector is relatively underdeveloped, not much in equity, that's the purple at the top, even less in bonds. So as the financial system develops, I think people are going to want to diversify, and I don't think housing is going to continue to expand its share of household wealth in China. And when it quits expanding, the demand for property is going to go down. Another reason is debt. Households have borrowed a great deal of money, particularly since the end of 2008. You can see roughly household indebtedness relative to after-tax income has roughly doubled. Mortgages are the biggest share of that debt. I think a lot of people aren't aware of the fact that Chinese households have a lot of access to credit from the banking system. This is no longer a banking system that just lends to state-owned companies. So at some point, households, hopefully they'll be wiser than households in North America, or at least in the U.S., at some point they may recognize that their capacity to finance more debt is limited, and they will not continue to borrow, accelerate their borrowings at the pace we've seen over the last 3 years. Just by comparison, the U.S. households, of course, got up to a much higher number, but in most years we're going up by 2% per year, 2.5% per year. As you can see, China's gone from roughly 30% to 50% in 3 years. And finally, looking at it from the point of view of banks, if you look at the total, the blue line shows you the share of the loan book of Chinese banks that is going for property, either mortgages to individuals or lending to property developers. And it's gone from around 13% up to something close to 20%. At some point, if banks are managing their risks, they will not continue to increase their lending to the property sector at the pace that they have over recent years. So any of these factors could lead to a slowdown in the demand for residential property. And the reason the investment share of GDP is so high is primarily because property investment has increased so much. And you look at the upstream and downstream linkages to property, it accounts for an enormous share of economic activity in China. It's not just the 9% of GDP going into property. 40% of China's steel output goes into residential property. A very large share of cement, aluminum, copper, and a broad range of other materials goes into residential construction. White goods, also very heavily tied, the sale of white goods, very heavily tied to new purchases of property. So there's a very large share of the economy that is tied to property. So if the demand for property goes down for any of the reasons I just suggested might emerge, then the economy, unless something else happens, the economy is going to slow down quite substantially. Now, I'm going to switch gears a little bit and do what I said I would at the beginning, and that is talk about the relationship between the imbalances I've been talking about so far, which are internal, too much investment, not enough consumption, too big a manufacturing sector, very small service sector, which is obviously related to little consumption, and talk about the external sector and what was it in particular that happened around 2003, 2004 that led the central bank to change its policy. Well, the background is that China fixed or unified its exchange rate system in the mid-1990s, around 95, 96. They were tied to the dollar. The dollar was appreciating, therefore the RMB was appreciating from the mid-90s up until around 2001 by about 4.5% per year. And as a result, as you can see in this diagram, China's current account surplus was pretty small, a little less than 2.5% per year. The Chinese weren't paying attention. The value of the dollar peaked in February of 2001 and then started to depreciate. And the Chinese stayed pegged to the dollar, so pretty soon the RMB also started to depreciate. And pretty soon China's current account surplus, as you can see by the blue line, after 2003, started to go up very, very rapidly. But remember, the currency didn't appreciate very much. It depreciated from 2001 through 2005. Since 2005, it's appreciated a little bit, about 30% cumulatively. But on average, over the last 7 or 8 years, the currency appreciation has been less than 0.5% per year. Well, in the face of a massive current account surplus, the central bank was basically given the assignment of keeping the currency from appreciating. And in order to do that, they had to buy up massive amounts of foreign exchange. It was about 3.5% of GDP in the early years, and the more recent years, it's been something close to 10% of GDP per year. This created a dilemma for the central bank. China's central bank, like all central banks, has its primary mission of maintaining price stability. But at some time around in the middle of the last decade, they also were given the assignment by the State Council or the Standing Committee, the Politburo, or whoever makes these decisions, that they didn't want the currency to appreciate very much, and so they had to intervene. Now, we always talk about intervening in the foreign exchange market, buying up foreign exchange, but what I like to do is to kind of flip that around. How do you buy up foreign exchange? You sell domestic currency. So a 9% purchase of foreign exchange as a share of GDP is a massive injection of money into the system, which would create eventually inflation and which would then conflict with the primary goal of maintaining price stability. So my hypothesis is that one of the reasons, so they had to sterilize the increases in the money supply. That's a term of art in the economics. It basically means you get that money back out of circulation, either by raising the required reserve ratio, which is the share of deposits that banks must keep at the central bank, or you issue bills. The central bank issued a very large quantity of bills. So these bills and the required reserves are what I call sterilization liabilities. So we always think that the central bank, in the form of its operating arm SAFE, has $3.2 trillion in foreign exchange reserves, but they also have liabilities that are very similar in size. And thinking of finance, if you have a liability, what does that mean? You usually have to pay some interest on the liability. And as you can see in this diagram, by 2007, 8, 9, and so forth, the liabilities were in the 40 to 45% range. And what was happening was the central bank was starting, actually throughout this period, the central bank was actually losing money. You know, it's investing in short-term treasuries that are currently paying 25, 35 basis points. It's paying 1.6% on required reserves. It's paying about 3% on bills. And so on a cash flow basis, the central bank was losing money. So in order to minimize the losses, they kept domestic interest rates as low as possible. So the first objective was to minimize their losses, to make sterilization less expensive, and essentially they shifted the cost of sterilization onto the banks, making them buy bills at a very low interest rate, put 21%, or at the peak last year, 21.5% of their deposits on reserve at the central bank, so they couldn't be lent out. And they got a relatively low interest rate. The banks were being very heavily taxed. Last year, the average loan rate was about 8%, and banks had 21% of their assets on deposit at the central bank, only earning 1.6%. They held a huge quantity of central bank bills, paying about 3%. So there was a big tax on banks. That brings me to the second reason that the central bank and the government more generally followed this low interest rate policy after around 2003 or 2004, and that is, remember that the government had invested, the estimates vary a little bit, but something in the neighborhood of 3 trillion RMB in recapitalizing the banks in the very late 90s and the early part of 2001, 2, 3. Created those asset management companies, rolled off 1.4 trillion in crummy loans, and so forth. I think it was I can't remember. I think this is when Zhu Rongji was still in power, and this is what he called, this is the Last Supper. No more bailouts. I think I have a slide on that. Maybe I guess I didn't put that one in. Basically, the government wanted the banks to be profitable, so they were making them take on a lot of, they were paying them very low interest on a lot of bank assets, which are central bank liabilities. But basically, the Ministry of Finance and the central bank made it up to the banks by setting the deposit rates very low. They set the deposit rates very low, so the banks had a very cheap cost of funding, very large spreads. You look at the data on international banks. Chinese banks in recent years have been making in excess of 1% return on assets, which is higher than almost any other bank in the world. It's even not weak U.S. banks, but higher than HSBC, Standard Chartered, and some others that have been performing very well, relatively speaking, in recent years. So the story then is sterilization was going to be expensive. The central bank didn't want to pay for it. They forced it onto the banks, and then by setting very low deposit rates, they forced it onto the household sector. So this was basically very typical of financial repression. It's redistributive. Some people are losing and some people are gaining. There was yet a third reason that they followed a low interest rate policy, and that was the fear of hot money inflows. In the period after 2005-06, there was a very wide expectation that the RMB would continue to appreciate, and indeed it has appreciated in real terms about 30%. So China has some substantial restrictions on inflow of money, but people thought, well, if the RMB is going to appreciate by 3% per year and I can put my money in a bank deposit or some other financial asset that earns a little bit as well, that looks like it might be a very attractive return. But this was a very bad thing for the central bank, because here they were already buying up 9.1% of GDP every year in foreign exchange to keep the currency from appreciating. They were worried that there would be and that almost entirely was explained by the current account and trade surpluses. They were also worried that a wave of hot money would be coming in, which they would also have to buy up to keep the currency from appreciating, and that would make the challenge of sterilization to maintain price stability even greater. So they didn't. Wu Xiaoling, who was a deputy governor 3 or 4 years ago, said we have to keep a differential between our interest rates and foreign interest rates in order to control hot money inflows. She said there's a risk, of course, that you will create an asset bubble. In other words, if you have very low deposit rates and people go into other assets like property, she said we're watching that very carefully. So in summary, 3 reasons why I think this low interest rate policy emerged in roughly 2003, 2004. Number 1, to hold down the cost of sterilization and to transfer it to the household sector. Secondly, to preserve the massive investment that the government had made in recapitalizing banks. Remember, they wanted the banks to earn enough money so if there were additional non-performing loans, they could be written off from their own earnings, so they wanted bank earnings to be very strong. And thirdly, they were worried about hot money inflows. So the combination of those 3 factors, I think, together led to this change in interest rate policy in roughly 2003 and 2004. Now, what's the solution? I'm a little going forward. Essentially, China needs to transition from growth that has been driven by investment to growth that is driven more by consumption. And the book is basically a blueprint for doing that. The most important thing you will not hear as any surprise, I think they should begin to liberalize interest rates. This would give people higher income, a real rate of return on their savings deposits. It would probably over time lead to a reduction in the saving rate, which would lead to a further increase in consumption. It would make property a less preferred asset, and so this overinvestment in property that has been characteristic of the last 6 or 7 years would be reduced. There are other things that need to be done as well. There are certain factor prices in China that are still controlled by the government, and they're priced at very low levels. They underprice energy and water, for example. Electricity is a very good example. You might think, well, that benefits households, but in fact, in China, fully 75% of all electricity is used in manufacturing. So one of the reasons we have an outsized manufacturing sector, and it's tilted very heavily towards heavy industry, is, first of all, capital is very cheap, so it's a subsidy for manufacturing. You don't need much capital in services in most cases, so the low cost of capital biases investment towards the industrial sector, and particularly with heavy industry, more capital-intensive industry. The underpricing of energy and certain other factors of production also reinforces that bias, also works against the service sector. So interest rate liberalization, factor price reform, more flexibility on the exchange rate. They've come some way, but I think the currency is probably still a little bit undervalued, so they need to allow market forces to play a greater role. My view, I don't get into the game of saying it's undervalued by X or 2X or something like that. My view is they should gradually reduce the intervention in the foreign exchange market, so the price of foreign exchange over time is determined by supply and demand in the market, and you don't have this extra government actor in there buying up so much foreign exchange. That might take a period of some time, but I think that's the direction in which they should move. And then finally, and again, there's a lot of discussion about this in the book, is to build out the social safety net. I think that would contribute to a reduction in the precautionary demand for saving. If people didn't have to self-insure for every eventuality, and there was going to be a medical insurance program that was more comprehensive, or a retirement program that was reached a larger share of the population, and so forth, that the savings rate, which is in the stratosphere today, would gradually come down. And that would also add to consumption. So that's the argument that you need to liberalize interest rates, reform the few factor prices that the government still controls directly, have more flexibility on the exchange rate, intervene less, and finally build out the social safety net. That's basically what the book is about. Well, the last chapter of the book does talk about, why hasn't this happened? Interest rate liberalization, the market-oriented interest rate liberalization has been on the reform agenda for years. They started out in this path back in 97, 98. Even during the height of the Asian financial crisis, they were gradually liberalizing interest rates. They allowed more flexibility around the benchmark rates that were set by the central bank. It all came to a screeching halt in 2004. No liberalization of interest rates since then. Even though it was a plank in the 11th five-year plan, Wen Jiabao, in his speech to the National People's Congress in March of 2009, said, and this is a direct translation, we must have market-oriented interest rate liberalization. Market-oriented, the same phrase appears in the 12th five-year plan, which we are now in, but very, very little has happened, and that's true of some of the other reforms that are necessary. So my political economy view is that these distortions in the exchange rate, interest rate, factor prices, basically are redistributing in a fairly untransparent manner, but you can still tell. Coastal provinces have been gaining from this policy at the expense of inland provinces. Exporters and import competing industries have gained at the expense of importers and consumers and households more generally. Commercial banks have become highly profitable because of the large spreads that this system brings them. Savers, on the other hand, are being subject to a very, very high implicit tax with a negative deposit rates. Property developers and local governments have done very, very well. Construction companies as well. I think it's very, very illuminating that if you look at this Who Run list every year that's put out by that is he Dutch, the guy in Shanghai, the richest people in China. You read the list year after year, about 7 out of 10, 8 out of 10 people on the list have made their money in property. So property developers and construction companies have done very well. Local governments, in some cases, have made a lot of money from land sales. The Ministry of Commerce has been a winner in this process. The Ministry of Finance has been a winner in this process. I put the People's Bank in the losing category. They have wanted to have more appreciation of the exchange rate sooner so that the need for massive intervention in the foreign exchange market would be smaller, and the challenge of maintaining price stability would be more manageable. But I think the ultimate problem is that there's a very strong coalition of regions, bureaucracies, interests, and so forth that have systematically opposed the kinds of reforms that I think are required to move China onto this more consumption-driven growth path. And I think the interesting question going forward is whether or not Li Keqiang and Xi Jinping will be stronger. I think, quite frankly, the problem of the last 10 years is we have consensus-oriented decision-making, and when you have a lot of conflicting voices at the very top, what's happened is that you get stasis. Nothing happens. They don't take decisions. So I think the real question is whether or not the regime that will be coming in to power starting this fall will change that dynamic and push ahead on some of the reforms that I've talked about this evening. Thank you.
That leads perfectly. Do you want to sit or stand?
Oh, I can stay here.
That leads perfectly into the first question, which is we have the World Bank study, which talks a lot about these kinds of reforms, broader, I think, than what's addressed in the book, is co-authored by an institute under the State Council, a research institute under the State Council. Is this a sign that we're going to see this liberalization occur, that they've kind of finally concluded that the rebalancing is not only necessary for their foreign relations, but necessary to sustain economic development internally?
Well, I can't answer that with any confidence. I'll just say a few things about the report. I haven't read the whole thing. It has 5 supporting volumes, and it runs 400 pages altogether. You can download it on the World Bank Beijing website. I did read parts of it early this morning. It's very, very good in that it's very comprehensive. It deals, everything from green development. They do talk about interest rate liberalization. It doesn't get quite the prominence I think it deserves, but and many other things, building out the social safety net, reform of state-owned enterprises, and so forth. I think I would make 2 criticisms of the report. It doesn't really identify priorities. Well, actually, it identifies 6 priorities, but it just about covers the waterfront. Everything's important, and I think in the Chinese system, they should be getting advice saying, this is the number 1 priority, this is the number 2 priority, this is the sequence. When you put out a 500-page report and say you've got to change everything, nothing happens. Nothing happens. Nothing may happen. I shouldn't be so predictive. And the second problem is they don't really go into the question of why these reforms have not been carried out in the past. And I think you really have to begin, and one of the things I try to do in this book is, if you'll read chapter 5, is to really, I think you have to shine a light. This is a highly redistributive system. And I don't think many people in China really understand how redistributive is and how certain segments and geographies and bureaucracies have benefited from this system, and they're not going to give it up easily. The biggest losers, of course, are savers, and as I said to one of my political science colleagues the other day, the last I checked, households weren't very well represented in the Chinese political system. So I think you really have to, rather than just have some vague, the report does have some vague language about political obstacles, but it's so anodyne. I think you really have to focus in on who's gaining from these policies. And I think if that's understood more clearly, then I think you have a much better chance of changing the system than you do in the absence of that kind of insight. So that's not enough identification of priorities. Everything has to be done, and not enough discussion of the political economy of China, why the reforms which have, as I said, been in the 11th five-year plan, the 12th five-year plan, but aren't being implemented.
I'll ask one more question, then open the floor to questions. A lot of the argument on the rebalancing relates to the consumption figures which you have out there and up there, and that consumption is too small a percentage. How does it account? It kind of defies what you see in China and what you see on Fifth Avenue in New York, that there is an enormous outpouring of Chinese consumption. And as knowing how the Chinese don't like to pay the VAT tax that exists, and some of this money that is used as consumption is from ill-gotten gains, how do we understand what the true consumption numbers are? Because so much of it is occurring off the books.
Well, this is an issue. I have a statistical appendix that looks at some of the weaknesses in the consumption numbers, and there are many. But even after you make allowances for what they're not counting, it's almost inevitable that the share of consumption is extremely low. Maybe it's not the 34% that the official figures showed last year. Maybe it's 38% or 39% or 40%. At 40%, it would still be the lowest of any economy in the world. And and you have to ask yourself, if consumption as a share of GDP keeps going down, I mean, this is not, you can't go to zero. So eventually there has to be a correction. The other thing I would say is
what's the gray market estimate in that? I didn't look at the statistics.
Well, the gray market, there are estimates of gray market income, unrecorded income, but the problem is that the people that have a significant amount of unrecorded income tend to be people in the top, certainly in the top decile, maybe the top 1%, and their savings rate is higher than anybody else's. So it could be that after you account for all this gray market income, that the savings rate is even higher than we think it is, because people in the bottom couple of deciles certainly are spending 100% of their income. They don't have enough money to be able to save any significant amount. The high savings is at the top. And I would say more generally, it's very tough to really make judgments about these things based on what you can see, because the average Chinese is not shopping on Fifth Avenue or Rodeo Drive in California, or on the high street in London and so forth. So, there's masses of the population that aren't engaging in the kind of consumption that's visible to Westerners, either traveling in China or seeing Chinese here.
Let me open the floor. Ken Miller.
Nick, on this whole hard landing, soft landing debate, a lot of people say, how could there be a hard landing? They're sitting on $3.2 trillion of foreign exchange, but they ignore this point you made about the concomitant liabilities. I wonder what you think about the resources that are available. Oh, and then there's this very interesting debate between Pettis and Kroger about hard land, the huge bad loans in infrastructure, the huge bad loans in local. How do you see this coming down? As a hard landing, a soft landing, what tools are available to the government?
Right. Well, I am not, I avoided trying to use the word property bubble or a bursting bubble or that kind of terminology or hard landing. I don't think there will be a hard landing in China. What I see is the greater risk is a long-term slowdown. I mean, if you take into account that a very large share of growth in the last few years has been generated by this outsized demand for property, and that it could gradually erode for reasons that I suggested, what you could have is a long-term slowdown that would, might last 2 to 3 years to get, and then you might bounce along the bottom. Remember, if property slows down, and you have, you're going to have declines in prices. I don't know how great they'll be. I'm not talking very much about prices and I'm not talking about risk to the financial sector. People still have to make down payments when they buy property in China. I don't think it's going to be a crash like Las Vegas and Phoenix and certain parts of Florida, et cetera, et cetera. But if property becomes less of a preferred asset class, demand for property is going to go down, and you could have a very long slowdown. And it would likely be quite prolonged because there would be a wealth effect. I mean, people now have 40% of their income tied up in property. If it's going to decline, it's now property prices are declining in a lot of cities, not dramatically, but they're beginning to decline. So you could have a long slowdown that's fairly prolonged. Now, what can the government do about it? I think the government's done the right thing so far, trying to bring property down, let the air out of the balloon a little bit by putting more restrictions on property investors as they have done. What can they do if there's a further correction? Well, they can't really use the foreign exchange reserves because you have to have domestic demand to generate economic growth, and if you if you convert all that foreign exchange back into RMB to spend it domestically, to increase pensions or improve the medical system or whatever, you would have to accept a very sharp appreciation of the currency, and that I don't think that would be a good idea because it would disrupt a lot of a very large share of the manufacturing sector is not going to be profitable if the currency appreciates by 20% as they spend down their foreign exchange reserves. So then you have to look at what can they do on the fiscal side and what can they do on the financial side. I think the bottom line is that they're much more constrained today than they were in the third and fourth quarter of 2008 when they launched their big stimulus program when they saw what was happening in the rest of the world. Government debt to GDP is twice as high today as it was in 2008. Bank lending has been maxed out. There's some headroom, but not so much. The way I put it on infrastructure is in 2009 and 10, they built 5 years' worth of infrastructure in 2 years. I think a lot of it will have high returns long term, but you can't repeat that every few years. So I think they're more constrained fiscally, they're more constrained financially. The infrastructure is less of an opportunity than it was in 2008. So I think the imperative is to get more domestic private consumption. I think that's what they should be aiming for. And in the process, they're probably going to have to accept lower growth, particularly if the property market correction is significant.
Keith? On this infrastructure question, recently I've been spending a bit of time in Yunnan Province, and it's no longer a place where the roads aren't paved, but it does give the impression of a place that could absorb a great deal more infrastructure than it has. I haven't traveled the length and breadth of the Western provinces, but is it really so that they can't continue to drive growth through infrastructure development, considering what a low base they've started from?
Well, the question, if you didn't hear in the back, is isn't there really a lot more headroom on infrastructure, and couldn't that drive growth? There certainly is some more room for infrastructure, but I don't think it's anything like what it was in 2008. They have massively built out the highway system. High-speed rail has gotten a very good start. I think that project will continue. But when you look at some other areas like airports and things like that, they already have massively large airports in all kinds of secondary cities where the gates are never filled up. If every flight that was scheduled for the whole day arrived at once, they'd have a gate for every flight. So in some areas, it's fairly clear they have built ahead of demand. Now, maybe there's some room in some of the western provinces, but also there are a lot of highways that when you travel on them, you don't see that much traffic. So I'm, in general, an advocate of infrastructure being a leading sector in building infrastructure ahead of demand, because I think that works better for sustaining long-term growth. And I think all you've got to do is look at India for some of the rationale for that, where the infrastructure has been a lagging sector and a big drag on growth for quite a few years. But yes, there's some headroom, but nothing like what there was in 2008.
Go all the way to the back.
There's been a huge increase in non-bank lending in China. Anecdotal, you've seen growth in pawn shops, and you've seen high net worth individuals with the banks acting as intermediaries. And some people say that historically it's been 25 to 40% of all financial transactions. In the 80s and 90s, the PBOC would crack down on these transactions. I don't think we've seen that yet. We've seen it. You have a listed pawn shop company in Hong Kong, and we've seen a lot of others growing. Is this just sort of a de facto interest rate liberalization that's occurring, or is it inconsequential?
Well, this is a very good question and a very complicated one, but let me try to give an abbreviated answer. I don't think I know the full answer, but I'm skeptical about the idea that this unregulated sector kind of has backdoor interest rate liberalization as an outcome. And I say that whether you're talking about underground banks or the wealth management products. I mean, take wealth management products. A lot of people don't want to get a negative return on their one-year deposit, so they buy these wealth management products from banks, and they earn a substantially higher rate of interest. But in most banks, you have to have like 500,000 RMB to invest in these products. So it's a half a billion RMB. So the average saver is not going to have access to this. So at the very top of the income scale, yeah, maybe some people are doing a little better than the official numbers, but I don't think it's generally available. The underground banks are a very similar thing. The underground banks that are so famous, for example, in Zhejiang province, rich businessmen put in a few million to their friends that are running one of these underground banks. But again, the average person isn't going to have access to it. In other words, I guess the way I put it is they raise their money to lend out in these schemes in a wholesale market. They're not taking in deposits of 25,000 RMB or 10,000 RMB from, say, typical households or smaller, less wealthy households. So I don't think there's too much interest rate liberalization going on. And I do think many of these phenomena that we're talking about are other manifestations of financial repression. When you have tight controls on interest rates and people look for alternatives, you get underground banks springing up, you get the gray market, and all these other things that have become obviously much more important in the last few years, because I think the reason is because financial repression has now persisted for quite a few years. And it's not like the U.S. where, if you put your money in a money market fund today, you're not going to earn anything. But remember, the interest rates have been negative in China now for 8 consecutive years, so on average. So I think that has led people to look for alternatives. That's why China is now the biggest gold market in the world. People are going into gold. You read stories in the press about jade prices have gone up 3,000%. So people are looking for real assets that will preserve value or perhaps have a potential for appreciation. I've even had people tell me about there's certain kinds of rare teas that age and get better with time. It's kind of like buying first growth Bordeaux's. You stick them away for 20 or 30 years, and then they appreciate. I don't know what kind of tea this is, but I'm told that connoisseurs are doing this more and more. I know some of the kinds of tea, but so I think all of those are a reflection of the kind of financial repression that I've been talking about.
Well, we got half the room. Carl?
I loved your presentation. I was a little curious. You flagged the point about the You flagged the point about precautionary savings, particularly rural households, for lower income households feeling that we need to sort of retain larger sums of our income, and that contributing to sort of high savings rates. I had thought that you were mentioning the need to build up a social service net as a real issue. I had thought that one of the flagship policies of the Hu Wen administration had been, opening up, rural medical care and the like. From an economic standpoint, it wasn't the case.
No, I identified 4 domains in which I think policy has to change: the interest rate, exchange rate, factor prices, and the social safety net. And in the book, I give more credit on the social safety net than any of the other 3 domains. And they have rolled out this rural cooperative healthcare medical system. They're not even rolling out a rural pension system. And these are very, very important innovations. And they're better funded over time. The cooperative medical scheme, for example, it's kind of a catastrophic healthcare insurance. If you go for a checkup, you don't get reimbursed. But if you have to go to a hospital for something, then you do get reimbursed. In part. In the early years, you were going to get reimbursed 30 or 40% of the cost. Now, in most places, it's up to 60, 70% because the government's putting more money into it. So it has improved significantly, but there's certainly much, much more that could be done. And part of it is a lag. The government announces it's going to have a rural cooperative healthcare scheme or there's going to be a pension scheme. Well, I think there's kind of a show-me attitude, and people don't discontinue saving immediately because they think there's going to be a good government program for them. a few years down the road. But I think gradually it will have an effect. But I think they could do more in that area.
TK.
You say that there would be more reform if people understood this dynamics of natural repression, that there are winners and losers. But on the other hand, you're saying reforms do not occur because the winners are opposing it. So why are they opposing it? Are they doing it sort of unconsciously, or somehow they know what's good for them?
Well, some of it's, a lot of it's very open. I have a lot of discussion in the book about how the Ministry of Commerce has systematically opposed more appreciation of the exchange rate. They've been very open, and they're always playing the same card. They go to leadership and say, if we appreciate more than 3%, tens of millions of people are going to be unemployed. All these, and I go through case by case, and then I show, well, over the next 3 years, we did have that much appreciation, and all those sectors that they were talking about being vulnerable, at the end of the period had more jobs, more output, more exports, that they were always, they were doing a very good job in representing the industries and scaring the leadership and talking about job losses. So they're pretty overt. I don't know how they have any credibility whatsoever, because they have consistently been wrong. In 2009, China did suffer a very substantial slowdown in its trade, but the Ministry of Commerce, in about halfway through 2009, said it's going to take 3 years before our exports get back to their previous level. 2010, their exports grew 30% and way above the previous peak. So they have consistently underestimated the productivity and the dynamism of the export sector. But a lot of this stuff goes behind the scenes. And I think the Ministry of Finance is probably the best example. Many people here would be aware that CIC, the Sovereign Wealth Fund, was created by this injection of $200 billion or whatever it was, $200 billion or $300 billion US dollars. But again, we forget there's a liability. The way that money was raised was that the Ministry of Finance floated a bond for $1.55 trillion, and when CIC got the foreign exchange, they also got the liability, so they have to pay the interest on the bond. Well, how do they do that? Well, the banks pay. The interest rates have been arranged that they have these massive spreads. They're highly profitable, and banks, unlike state-owned manufacturing enterprises that don't pay much in the line of dividends, banks have been paying out 50, 60, 70% of their earnings in the form of dividends, most of which go straight to Central Huijin, which is an operating arm of CIC, and that's the money they use to pay the interest on a very large bond issuance, the biggest bond ever issued in China. The Ministry of Finance is dead set against having interest rate liberalization. It would cut bank profits. It would reduce dividends. And if CIC can't pay the interest on that bond, who do you think is going to, who are the bondholders going to be looking to for their interest? It's going to be the Ministry of Finance. And the Ministry of Finance is, very cautious. They don't want to even contemplating having to spend tax revenues to pay the interest on this huge bond issue.
Isn't the
Pardon?
they're investing dollars, but their liability is 1.5 trillion RMB?
Yeah, because they raised the bond and SAFE got the 1.5 trillion RMB and handed over the foreign exchange to CIC. But Ministry of Finance also handed out the liability to pay for the bond to. That's why Law Ji-wei on the first day said, I have the worst job of anybody in the world. I have to earn, I think the number he used was 300 million RMB per day just to pay the interest.
And an appreciating currency, which makes it...
Yeah, an appreciating currency, which made it tough to earn very high returns on their investments.
Okay, right here.
In your advocating the building up of the social safety net, are there any particular areas that you would like to see prioritized and given more focus than others?
I think there are a couple. I would put pensions near the top of the list because I think that pension money is mostly spent. It's not saved. And the second I would have is medical. So higher payouts to people. And pensions have been raised. In the last 5 years, I think now for 5 consecutive years, they've raised pension payments, those people that are already drawing a pension, by almost 10% per year every single year. So, and this is in a period when price inflation, we had we had a couple of spurts of inflation in 08 and then again in 11. But the real increase in pension payments to those people that are already retired is quite high, way, way in excess of inflation. And I think medical is the second, because I think that's where the precautionary demand for savings is very high. And there's also evidence from other places. You can see it in Taiwan had a system in which about 40% of the population had medical coverage. Okay, you probably remember what year it was. And some year in the 1980s, or maybe it was in the 1990s, all of a sudden they expanded the program, and within 2 years, 90-some% of the population was covered by the medical insurance scheme, and the household savings rate went down within 2 years by several percentage points. So I think the evidence is that there's a pretty fast response to the improvement of a wider expansion and improvement of the coverage of a medical insurance scheme.
And that's being expanded in fact. Is that correct?
Yes.
In those areas?
Yes.
So we still have a lot of hands and not much time, so let me do Frank and then Jeff, but keep it real short.
Yeah, question about your winners and losers. On your winners, you had property developers. On your losers, you had first-time household buyers. My understanding is that rural people, and I'm bringing the experience from rural Guizhou, where I've been recently, they are very concerned about their land. Now, the land is not owned by them as an individual or a household. It's owned by the collective. But the typical practice, we saw this in Wuhan that the New York Times covered a great deal, is for deals to be made over the rural people's heads, and for them to consistently lose land and get very little or no compensation. Now, the other side is people who have migrated to the coast
Question, Frank.
have the intention of going back to their rural hinterland as their retirement pension basket. So if those two realities are there, and if Wuhan is any example, that's a tripwire of political opposition, what's the policy that needs to be done on this question of the safety net in especially the interior rural areas?
Well, I think you put your finger on a very problematic area, and local governments have made lots of money from taking land away at very low compensation rates to farmers and then reselling it to property developers who have made massive amounts of money. I think they have to go to a system where they have to go to a system where the land is sold freely or at some kind of auction. So there is a market price, and if farmers want to sell, they can sell, and if they don't want to, they don't have to. I think that's the only viable long-term solution.
Jeff.
I agree with everything you've said. I think it's a good picture. But you don't emphasize another potential lever that may be beginning to boost consumption. I hear the anecdotes. I don't know how to read the data well enough to know how strong it is. What is the likelihood of significant wage increases, transferring income to workers,
right,
and allowing an increase in consumption?
Well, there's a section in Chapter 3 in which I have a probably some people will think it's a too exhaustive analysis of wages, but basically, there are people like Ross Garnow in Australia who've been saying since 2006, this whole problem is going to take care of itself. The government doesn't really have to adopt any policies. There are labor shortages. Wages are going to rise very rapidly. The wage share of GDP will go up. Therefore, consumption will rise, and this long-term diminution of consumption as a share of GDP will kind of be self-correcting. I am, in a word, very, very skeptical, because if you go back and look at the data and look at all the segments of the non-agricultural population, whether people in the formal sector, informal jobs, or working for themselves, these Guti people or migrant workers, and you go back and look at the best data we have, average wages for all these people have been going up by 10% per year in real terms for a decade. 10% per year in real terms. So a lot of people started focusing in on this wage thing. They read about those strikes at a couple of Japanese plants that were producing automobiles, and there were big settlements. Or you read now Foxconn's going to raise their wages 25%. wages have been going up very rapidly in China, even as consumption has been declining. And part of the answer is, of course, that labor productivity has gone up very rapidly, so unit labor costs have not gone up. Profits to manufacturers have continued to go up, and the consumption share of GDP has slid. So if wages start going up even more rapidly than at 10%, or productivity growth slows down, then I think this kind of automatic recalibration, rebalancing could become a factor. But I don't think it's going to work very, very rapidly. And you can see big companies like Foxconn are moving to the interior where wages are lower. I remain in the skeptical camp that this kind of autonomous, automatic rebalancing through wages is going to work, is going to be strong enough and fast enough to rebalance the economy.
Patrick, last question.
I read something.
Louder.
2010, China was settling its trade in RMB. It's about 1% of total trade.
Oh, I can't quite hear you.
2011.
Louder.
Can you hear me? Sorry.
Yeah.
I read something recently where China was settling its trade in RMB. In 2010, it was approximately 1.5%.
Selling its what?
Trade settlements. And about 1.5% in 2010. And then in 2011, it was about 11%. And then I read some sort of economic forecast that it'll be 30% in 5 years. What are the positive and negative implications of that?
Well, this is a good question, but maybe not a very good last question because it's fairly complicated. But basically, the trade settlement, in other words, settling trades in RMB, which began, as you said, a few years ago and now has taken a substantial portion of China's total trade, is one aspect of the internationalization of the RMB, which some people hope, and the People's Bank put out a report last week laying out a blueprint to over a 10-year period to get to convertibility. So you have internationalization, then you liberalize on some of the capital account items, then you get to capital account convertibility, then after you achieve that, then maybe you would have some significant use of the RMB as a reserve currency by other countries. I think it's a very good idea, but I'm not sure that there's a sufficient appreciation of what a major step it is to go from just trade settlement in RMB to capital account convertibility. Because to have capital account convertibility, first of all, you have to have flexible interest rates. If there's a big gap between domestic interest rates and foreign interest rates when you go to capital account convertibility, either the money is going to pour into China or it's going to pour out of China and could be highly destabilizing. So you have to have market. I'm not saying it has to be exactly the same interest rate as somewhere else, but that has to be determined by market forces rather than just being pegged by a central bank as it is today. Secondly, you have to have an exchange rate that's perceived to be, and in fact, close to some kind of an equilibrium rate, because again, if there's an expectation that the currency will appreciate, then the money will be flooding into China. People will want to buy up RMB assets because you're going to get the advantage of appreciation, and that could be destabilizing. On the other hand, if it's overvalued, you're going to have big outflows. So you have to have a market-oriented exchange rate mechanism to have capital account convertibility. And the third thing you need is a very deep and liquid corporate bond market, because when you open up on the capital account, a lot of foreigners are going to want to invest in China, and there have been very, very restrictive opportunities so far to make portfolio investments in China. But the corporate bond market is very, very small, dominated by a handful of major banks and other issuers like the Ministry of Railroads, and private issuers are far and few between, and the market is very small and not very liquid. And China's been talking for a decade about developing a bigger and deeper corporate bond market, and they're beginning to make some progress the last 2 or 3 years, but they have a long way to go. So 3 big hurdles to move just from trade settlement in RMB to capital account convertibility: market-determined interest rate, a market-determined, or not pure, largely market-determined interest rate, largely market-determined exchange rate, and deep and liquid corporate bond market, so that when foreign capital comes in, you won't just bid up asset prices, because there'll be a lot of money chasing very, very few assets.
Well, this has given you a taste of what's in this book.